Feeling the financial squeeze? Discover why consumer confidence is plummeting, Bitcoin's potential as a global currency, and looming threats to the housing market. Our experts provide eye-opening insights. Don't miss out. Today on Financial News in Review, we will summarize the following videos. From Adam Taggart, Thoughtful Money, we have too high cost of living is destroying consumer confidence, Joanne. From Blockworks Macro, we have altcoins going to zero and Bitcoin headed to the moon, Jonah Bourg on crypto and oil. From David Lin, we have Will cost of living crisis get worse? Why consumers are getting squeezed, Tomas Philipson. From David Lin, we have Repeat of 2008 Financial Crisis as Wave of Foreclosures Coming, Chris Vermeulen. From the Julia Roche Show, we have Central Banks Are Playing a Dangerous Game, Peter Boockvar. In this Thoughtful Money interview, host Adam Taggart engages in an eye-opening conversation with Joanne, the director of the University of Michigan's Consumer Sentiment Survey. The topic of discussion revolves around the stark realities of consumer confidence amidst skyrocketing living costs. Joanne brings a wealth of experience to the discussion, having worked at the Federal Reserve and specializing in consumer sentiment and economic research. Importantly, Joanne's data-driven insights are unbiased and deeply rooted in empirical evidence. The core thesis of this interview is centered on the idea that, despite strong labor market indicators and GDP growth, consumer confidence is deteriorating due to the high cost of living. Joanne explains that while some households are managing to stay afloat, the majority feel burdened by rising prices, leading to a significant decline in consumer sentiment. Here are the key points discussed by Joanne. Current state of consumer sentiment. Consumer sentiment is below average historically, but has improved by 30% since the trough of mid-2022. Despite strong labor market indicators and GDP growth, consumers feel weighed down by high prices. High asset prices are not enjoyed evenly across the population, contributing to wealth inequality. Inflation and its impacts. Inflation peaked in mid-2022, causing significant concern among consumers, particularly those in lower income brackets. There's a bifurcation in consumer sentiment. Higher income households are less impacted by high prices compared to lower income groups. Labor market data. Consumers generally have positive views about job security and future income growth. However, there are rising concerns about the reliability of labor market data and potential future increases in unemployment. Methodology of the Consumer Sentiment Survey. The University of Michigan's surveys of consumers has transitioned from phone to web-based interviews to adapt to changing data collection trends. This transition has shown to preserve the integrity of the time series data. Wealth inequality. The pandemic caused a temporary convergence in consumer sentiment across income levels, but this has since reverted to pre-pandemic levels of inequality. Future trends indicate a continuing widening of wealth inequality. Joanne made the following predictions. Future economic sentiment. Joanne predicts that consumer sentiment will remain volatile in the coming year due to uncertainties, including the upcoming election. Impact of a possible recession. If the strong labor market weakens, it's predicted that consumer spending, particularly from middle and lower income groups, will significantly decrease. Wealth inequality widening. Upcoming economic trends are expected to widen the wealth inequality gap due to divergent asset ownership and income growth rates. Joanne concludes by emphasizing the dual forces at play. While high-income households can weather the economic storm relatively unscathed, lower and middle-class families are increasingly vulnerable. The high cost of living and rising prices erode consumer confidence and weaken economic stability. There's no quick fix, but addressing fundamental issues in higher education and childcare could help mitigate some of these disparities. Viewers are encouraged to pay attention to these economic indicators and grasp the broader implications for societal well-being. Welcome to Blockworks Macro. In today's video, we have a veteran in the world of commodities, volatility, and crypto trading, Jonah Bourg. Jonah brings his vast experience from trading desks at Lehman Brothers, Goldman Sachs, and the world's largest oil trading company, Vitol. Most recently, he transitioned to the dynamic world of crypto trading at Cumberland, DRW's cryptocurrency arm. His extensive background ensures he brings a well-rounded, informed perspective, though it's worth noting his bullish stance on Bitcoin could introduce some bias into today's discussion. Jonah Van Bourg shares his insights on why altcoins are likely heading to zero, while Bitcoin has immense long-term potential, greater than any other asset in his view. He discusses the structural and geopolitical factors that set Bitcoin apart from other cryptocurrencies and why he believes Bitcoin will play a significant role in global trade in the future. Here are the key points discussed by Jonah Van Bourg. Bitcoin as a commodity. Jonah explains how Bitcoin behaves like a commodity, starting from mining or purchasing it and then refining it through gas fees to make it useful. He compares Bitcoin to other commodities like crude oil, emphasizing its utility once it is refined. Crypto market dynamics. Despite his long-term bullish stance on Bitcoin, Jonah anticipates short-term volatility, or CHOP. He highlights how the market has pulled back from its peak but lacks fresh investment, constraining dramatic price increases in the short term. Bitcoin's geopolitical relevance. Jonah believes Bitcoin will eventually serve as a global reserve currency, especially for significant transactions in international trade. He cites examples such as oil transactions between Nigeria and China, where Bitcoin could simplify and expedite payments, bypassing traditional currencies and banking systems. Impact of altcoins and market sentiment. Jonah asserts that most altcoins will lose value significantly as retail and institutional interest dwindles and regulatory clarity is required for genuine economic activity. He mentions the recent drop in Bitcoin prices linked to the release of Bitcoin from the Mt. Gox incident as an example of market sentiment impacting prices. Predictions for future crypto and market behavior. He foresees a downturn for the altcoin market, while Bitcoin and other major cryptocurrencies like ETH and Solana will maintain their value. Jonah predicts growing use of Bitcoin for geopolitical reasons and significant transactions, ultimately leading to broader adoption. Jonah Van Bourg made the following predictions. Bitcoin's role as a global reserve currency. Jonah predicts Bitcoin will be adopted by more countries and large trading companies for significant transactions, replacing weaker fiat currencies. He argues the need for a common financial denominator that can operate outside the control of any one country's monetary policy. Altcoin market collapse. Jonah anticipates a major devaluation in most altcoins due to lack of new capital inflow and increasing venture capitalist unlocks. He stresses the necessity of regulatory approval for altcoins to disrupt traditional financial systems meaningfully. Jonah Van Bourg summarizes his bullish thesis on Bitcoin, emphasizing its unique position in the crypto market and its potential as a major reserve currency in the future. He advises viewers to stay cautious of altcoins, suggesting most will not survive without proper regulatory frameworks and genuine economic backing. Jonah stresses the importance of focusing on the long-term potential of Bitcoin and major cryptocurrencies and staying updated on their evolving market dynamics. Welcome to another insightful episode on the David Lin channel. Today, we have the privilege of hosting Tomas Philipson, the Daniel Levin Professor of Public Policy Studies Emeritus at the University of Chicago Harris School of Public Policy and former acting chairman of Trump's Council of Economic Advisors. Tomas is an expert in economic policy with extensive knowledge on the economic challenges facing Americans. Description: the core thesis of this video revolves around the ongoing cost of living crisis in the United States and its broader economic implications. Tomas Philipson explores how persistent inflation, stagnant real income, and government policies are squeezing American consumers. Here are the key points discussed by Tomas Philipson. Current state of the economy. Despite a dramatic decrease in inflation from its peak during the pandemic, real income for Americans has remained flat or even decreased during Biden's term, severely impacting the standard of living. The prolonged and heavy deficit spending, instead of encouraging growth, has been problematic, leading to an unusual combination of weak GDP growth and stagnant real wages. Federal policies and their impact. The Inflation Reduction Act of 2022, touted as a measure to curb inflation, has instead raised prices, particularly in pharmaceuticals, notwithstanding claims to the contrary. Government measures, such as price controls, have failed to mitigate inflation effectively and, in some cases, exacerbated the issues. Key economic stressors. The biggest increase in prices has been in credit costs, where mortgage rates have skyrocketed, nearly doubling the cost for the average homeowner. Inflation has affected vital sectors such as food, energy, and healthcare, significantly straining consumer budgets. Public perception and reality. The perceived strength of the labor market and stock market is deceptive when adjusted for real terms, showing much less growth than claimed. Tomas Philipson made the following predictions. Continued high inflation. Inflation is predicted to hover around 3 to 3.5% annually, remaining a persistent issue with no immediate solutions visible on the horizon. Increased economic pressure from government borrowing. Rising federal debt levels and their associated servicing costs are predicted to place additional pressure on federal spending, crowding out potential investments in other critical areas. Summary. Tomas Philipson concludes that the American economy is in a precarious position, with the cost of living crisis persisting largely due to ineffective government policies and runaway inflation. He advocates for significant federal spending cuts as a necessary corrective measure, and emphasizes the need for pragmatic economic policies to improve the real income and living standards of Americans. Call to action. Tomas encourages viewers to stay informed about economic policies and their effects on everyday life, and to consider advocating for more effective government interventions aimed at stabilizing and boosting the economy. In today's enlightening episode on David Lin's YouTube channel, we delve into the imminent housing market crisis with none other than Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. Chris Vermeulen brings forth a compelling argument centering on an anticipated financial crisis driven by a surge in mortgage defaults and foreclosures. He asserts that, much like the 2008 economic downturn, the housing market is on the brink of a significant collapse, exacerbated by rising interest rates and over-leveraged homeowners who stretch their finances thin. Here are the key points discussed by Chris Vermeulen Real Estate. Stress and mortgage renewals. Many homeowners are struggling to renew mortgages initially secured at very low rates, now facing significantly higher interest rates of around 5.5%. Canada, in particular, is witnessing a potential bloodbath over the next 2 years due to high mortgage rates from the end of the COVID era's low-rate environment. Market patterns and construction trends. Single-family housing construction starts declining since 2021 indicate a market breakdown. Multifamily constructions are surging as investors seek profitable ventures amidst rising material and labor costs. Historical parallels. Comparison of current real estate ETFs with those from 2006 to 2007 highlights similar housing start trends before the last major financial crisis. The guest uses historical data to argue for a repeat of the dramatic market downfall mirroring the 2008 crisis. Chris Vermeulen made the following predictions. Stock market correction driven by bank failures. Banks are setting aside large reserves to cover anticipated bad loans, hinting at a systemic risk that could lead to significant drops in share prices and earnings. Foreclosures and plummeting property values could trigger widespread economic repercussions. Parallel to 2008 financial crisis. Vermeulen predicts a rinse and repeat scenario where banks will hold devalued properties leading to foreclosures and financial strain similar to the 2008 financial mess. Chris Vermeulen concludes by emphasizing the impending pain for those over-leveraged in real estate. He advises caution and suggests waiting for the market to bottom out before considering new investments in real estate. Chris underscores the importance of preparedness and informed investing in navigating the tumultuous times ahead. In this recent episode of the Julia LaRoche Show, Julia LaRoche sits down with Peter Boockvar, the Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. They delve deep into the intricate and perilous game central banks are playing with inflation, interest rates, and economic stability. Peter Boockvar's core thesis revolves around the assertion that central banks, particularly the U.S. Federal Reserve, are treading a fine line in their battle against inflation. Boockvar warns that easing off too soon could result in a resurgence of inflation, akin to what happened in the 1970s. The discussion emphasizes the mixed and uneven nature of the current economy, an environment that complicates monetary policy decisions and economic predictions. Here are the key points discussed by Peter Boockvar: central bank actions and market reactions. Boockvar stresses that central banks are wary of easing their inflation fight, fearing a repeat of the inflation spikes from the 1970s. He suggests that Jerome Powell, chairman of the Federal Reserve, will likely be cautious in any rate cuts, possibly limiting them to small, incremental reductions. Evidence. Historical parallels from the 1970s and recent CPI data indicate ongoing inflationary pressures. Mixed economic indicators. Boockvar illustrates the mixed signals in the economy with examples. The housing market shows existing home sales at near 30-year lows, while new builds are slightly better. In the labor market, despite a historically low unemployment rate, other indicators like initial claims and job openings suggest weakening demand for labor. Impact of higher interest rates borrowers. He explains that the higher interest rate environment, though now normal after years of near zero rates, is causing significant strain, especially due to refinancing existing debt at much higher rates. Examples include the impact on businesses with debt maturities and households with adjustable rate mortgages. Peter Boockvar made the following predictions. Slowing economic growth. Boockvar predicts that U.S. economic growth is more likely to slow down from the current pace rather than accelerate, primarily due to the ongoing adjustment to higher interest rates. Temporary inflation moderation. He bets on temporary moderation in inflation rates in the back half of this year, possibly dipping into the 2% range before climbing back up, due to factors like global supply chain shifts and ongoing government spending. Peter Boockvar concludes by emphasizing the need for cautious and strategic investment in the current economic climate. He advises against getting swept up in the hype of high-performing sectors like AI and instead advocates for a diversified investment strategy that includes commodities, precious metals, and sectors poised to benefit from global economic shifts. He highlights the necessity of adjusting expectations to a new economic norm characterized by persistently higher inflation and interest rates. Tomas Philipson highlighted the ongoing cost of living crisis, exacerbated by ineffective government policies and persistent inflation, leading to stagnant or deteriorating real income. On the other hand, Jonah van Bourg presented a bullish outlook for Bitcoin, arguing its potential as a global reserve currency while predicting a downturn for most altcoins. Lastly, Chris Vermeulen warned of an imminent housing market crash similar to 2008, driven by rising mortgage rates and over-leveraged homeowners. Despite their different focus areas, all experts agree on the critical impact of inflation and volatile financial markets, but diverge on the best safe haven investments and the future of cryptocurrencies. Thanks for watching Financial News and Review for June 25th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.